This is a promotional podcast for EIS Platforms Limited Trading as Growth Invest. Any comments made or opinions expressed in this podcast should not be construed as investment advice or a financial promotion. Startups and early stage businesses are high risk investments and you are unlikely to be protected if something goes wrong. Don't invest unless you are prepared to lose all your money. Hello and welcome to Alternative Thinking with Steve Dobson and Melissa Griffith. This is the podcast that takes a deeper dive into the alternatives marketplace and exploring topical issues. Today we've got our regular guest Paul Mattick from Mercia and Northern.
Hello.
And we've also got Andrew from Downing. Andrew, could you just give us a quick update on your role at Downing, as we've got you as a special guest today instead of Nick Priest?
Of course, yes. I'm here in replacement of Nick. So my role at Downing is as Strategic Partnerships Manager. Again, just to give a bit of background on me, I was a financial advisor for a number of years before joining an EIS fund, and I've now been at Downing for about 18 months. So what we do within strategic partnerships, we work with a lot of the national businesses with regards to panel positions, work alongside our sales team and sort of some of the other teams within Downing, whether it be product and legal and so on, and just trying to make everything work for the strategic partners around the industry.
Perfect. Well, lovely to have you. So we're going to concentrate on the budget.
I think, Melda, before we go to the budget, we should talk about recent events with the US election. What's your views, guys?
Do you want to take it away?
Yes, well...
we can't spend the whole hour talking about
it. We could very much use Mr. Orange.
Mr. Orange.
Yes. I think it was not... Yeah, the press didn't have Trump as winning until like the middle of the night, and but him coming through actually quite a scale by the sounds of it. I think he won the popular vote as well as the overall, I'm not sure about the Senate and the House. I think he's basically had a pretty good showing. Yeah, I think many of how much you actually take on his word versus his actions is a different question. But if you look at, he's quite pro-business, he's quite progressive. I think there'll be more, as a result, more M&A in the market, which is, I think, definitely a good thing for UK. And you've already seen the stocks rocket in the S&P and crypto going. I think, it's a strong character. And so far, it hasn't had a positive impact on business, but we'll see over the next few years how the policies actually pan out. I'm not his biggest fan, but
the jury is out.
Yes,
I think you might have gauged that from Mr. Orange. Yeah, look, in a very similar boat, I agree that he's very pro-business. But how do you get to that point? You think of he's very he loves a tax cut, but where does that money go? I think the US borrowing...
Liz Truss loved the tax cut too, so...
Yeah, that's true. But I think that their level of borrowing is an issue, and the interest that they're paying on that and so on, the level of government debt, to provide tax cuts is all well and good, quite the opposite to our recent budget. But how do you get there? And that then becomes a bit of an issue. I think the other thing that you probably want to take into consideration that some of the listeners might consider is UK expats living in the US, what that means for them in terms of bringing income in. Obviously, the same for the US expats living in the UK. What does that mean for them? There's a lot of question marks, I think, and as you say, he is a bit of a question mark in himself. You never know what he'll tweet tomorrow. Versus,
just expecting Elon and Donald to have tweet storms overnight. Now this massive new policy appears.
I know, and yet they're apparently best friends.
Yeah. But then next thing he'll be banned from X again.
Yeah, exactly. Exactly.
Well, the Department of Government Efficiency sounds like a very good thing if the government's that big, but we'll actually see if it happens. But,
exactly. Yeah, and then, well, funnily enough, you talk about Elon. Obviously, it's slightly off tangent, but he's huge about reducing the level of... He wants to reduce the entire size of government. He wants to, reduce that cost and that sort of thing, which is effectively what he did at X or Twitter. I think he cut, a huge percentage of the workforce, and he wants to drive that. And yet he's talking about this, Department of Government Efficiency, Doge, I think he's calling it. Yes. Which you sort of think, okay, so you're trying to bring down the cost, and yet by trying to bring down the cost, you're going to incur more cost to create this new government department. I mean, it's just a bit of it's a bit of a whirlwind in the US. I think it always has been. But overall, I think that Trump. I don't want this to sound like I'm a supporter of Trump. I think he is actually slightly misunderstood because of how he
Quite easily to misunderstand the
slightly.
chap.
Don't get me wrong. I'm not a fan personally. I would have much preferred Kamala Harris, in my opinion. But I think that he is slightly maybe misunderstood on things because of how brash he is, maybe in the public eye.
Yeah.
And I think that there are certain elements, as you say, that will be really good for, hopefully for international relations. Obviously, he's talked about tariffs and all this sort of thing that are going to go, skyrocket. But the UK and the US have always had a good relationship, and you'd hope that continues.
So do we think on the whole it's going to be good for UK? I mean, Paul, you made the point there about M&A activity. We saw the markets react strongly yesterday. Obviously, dollar was strong, but actually UK sterling was strong against the likes of euro and Asian currencies. So do we think it's good for UK in the bigger picture?
Certainly in the private markets, I think it is, because the more M&A is allowed to happen in the US, but that has been very restricted. And I think they'll be looking to the UK for cheaper, earlier stage technology companies. So I think they'll be coming across the pond to actually get some new technology, which we might want to try and hold on to the UK companies. But
there's two sides to every story, isn't there?
Yeah.
No, I completely agree. I think it is because of how close that relationship's always been. I think that they would look, as you say, to the UK sort of first and foremost for developing more M&A and growing business from both sides.
Well, we recently had Callum Pickering on from Peel Hunt, and we very much had the same sort of perspective, didn't we? That it's going to be quite good, a bit more of a stable environment. The UK actually could look cheap on valuation terms and pretty promising going forward. And moving back onto the budget, that's given us a bit more stability in a way of where things are going. So let's go with the first changes, which obviously we're going to look at you, Andrew, is IHT. What's your thoughts?
Well, look, I think, as with every budget, I think there is this political game that's played where they release things that you'll see on Citywire and Professional Advisor months before, and they use that to gauge, how well is this sort of sitting with people?
The perception of...
the perception.
Do you mind, do you want to just go over the kind of key points of the changes towards IHT in the budget, just for the listeners?
Sure, yeah, of course. So from a business relief perspective, I suppose, is the angle I'll come from. I'll come on to pensions in a bit. But the biggest change is that AIM relief has been, as Rachel Reeves referred to it, as a 50% discount, being that it was 40% relief on any AIM business relief. So any business relief assets that you held within the AIM market were 40% relief. That is now dropped to 20% on all assets.
And to make clear, that is right from the start. There's no 1 million...
There's no 1 million, This obviously kicks in April 2026. But, so there's no 1 million threshold as opposed to private businesses or unlisted business relief, so unquoted assets, which will have a 1 million threshold of 0% or full IHT relief at 40%, and anything above that is 20%, same as AIM.
Yes.
So that's sort of the biggest change from a business relief perspective. And I'll touch on the pensions change in a bit, but I think that what we found with that is, because of everything, as I mentioned, that came out in the news and all this sort of thing, we actually thought, that was all right. That wasn't as bad as it could have been.
I guess the AIM reaction as well is key to that. Everyone thought AIM was going to tank on the back of the news. I mean, Paul, we were on a chat that day, and I think the interpretation of the rule changes, one was difficult to digest at first without getting the detail. But then secondly, I think the knee-jerk was AIM's going to be off on the back of this, but it seems it was priced in for total removal of relief.
Yeah.
It's expectation management, wasn't it, really? They actually did a pretty good job, like including in pensions. They were saying about the pension relief being removed at higher rates, but then it didn't quite happen. So they said the worst case scenario in the press, and then actually it was a little less harsh, wasn't it? Actually, overall, I'll let you back on to BR in a minute, but I think overall the budget wasn't anywhere near as bad as we were kind of expecting, and I think it was quite a good budget in some ways, actually.
Especially to plug that, whether it be 16 or 22 or 40 billion pound hole, whatever it is. It's such an interesting one, because I find that every time, and it comes back to, again, releasing things, out in the open, and everyone sees the doom and gloom, you almost sit back at that budget and think, or you're almost thankful, which is odd, even though, because there's been all this talk of, as you say, AIM probably priced in, abolishment, and or certainly something to that effect. And I think on the day the AIM all share was rallied, was up 3.5% or something. It's gone down a bit now, but So you could see that, as you say, from market sentiment. But I feel like from every aspect, they sort of, because there's all these things released out into the ether, and people are saying, this is terrible, tax-free lump sums might be cut and all this sort of thing. You then sit back and everyone almost goes, thank you so much.
Yeah.
And I sort of used an analogy with you yesterday.
I was about to bring that up.
Yeah, it would almost be like, I said to Steve yesterday, it's almost like if I said, Steve, I'm going to punch you. And he went, oh, please don't do that. And then I said, you know what, Steve, actually, you're a really good guy. I'm not going to punch you. You'd always go, thanks. But the fact I even threatened to punch you in the first place would be ridiculous.
And yeah, I feel good about it now.
You know what I mean? So I feel like
Paul's never said that, by the way. Nick never did, so we may not have you back.
And I don't mean it. I promise I wouldn't. Yeah, depending on how today goes. No, but it's that psyche, of people then sitting back and almost thinking, oh, thanks, that wasn't as bad as you could have made it.
Except for the farmers.
Except for the
Except
farmers.
for
I was going
Yes.
to bring
Yeah.
up.
Yeah, that's true. Okay, yeah, they may want to
Punch someone.
punch someone, exactly.
Clarkson does.
Yeah.
And as I was saying before, sorry, obviously those are the changes to business relief with regards to IHT. And the other huge point sheet, which I think, Rachel, we've spent about 12 words on, was that inherited pensions will be now included to form part of the IHT.
And this is
liability.
a big thing, isn't it? 12
Yes.
words
Oh,
was really not
That
enough
to me
to-
was
Yeah.
the biggest thing in the budget.
It is
Yeah.
biggest
Yeah.
by far because
Yeah.
pensions, I think, was 2.5 trillion in the
Mm.
UK. So a small percentage of that being removed from that wrapper, where's it going to go?
Yeah, exactly.
Maybe BR.
Well, maybe beyond, exactly.
Well, that's what I was going to ask. I mean, are you beginning to see a shift in demand and changes in, are people moving from AIM to asset backed, or what sort of trends you're seeing?
I think one
result?
thing that we are seeing, we're certainly seeing it as a query from advisors. You
Yeah.
know, can we do that? There's a question around the replacement relief on whether you can move from AIM to unquoted.
Can you explain that a bit for us? And
Right, yeah. So in the UK, you qualify for replacement relief if you have assets held in a BR qualifying scheme and you, say, remove them from that scheme and then reinvest them. So, for example, you might have someone that, I'll come back to sort of, I think, the point you're getting at, but for example, you might have someone that owns a business relief qualifying business. They sell that, they're out of the market for, let's say, a year, and then they think, okay, I've got, some people might still think they qualify for business relief. So what you can do is if you've held it for a certain number of years, I think it's 2 out of the last 5 years you've held it as business relief, you can effectively reinvest that, and from day dot, you're qualifying for business relief again.
Right.
That's what replacement relief is. So what a lot of people have been asking is, because of now the difference in unquoted and AIM relief, one being
Yes.
40% IHT relief and one being 20, can I simply move client assets utilising replacement relief from AIM into unquoted? Now, whether they make a change to the legislation is a question, but the current legislation states that you cannot receive more replacement relief. I won't, this isn't verbatim, but you effectively cannot receive more replacement relief had the replacement not happened.
right.
So in this case, for example, if you have a client with £500,000 in AIM and they're looking to move it to unquoted, that clock would actually restart. You'd have to re-qualify for the business relief,
Right,
because
okay.
you'd be moving from...
So you're back on your 2 year.
You're back on your
timescale.
2 year.
Yeah.
Yeah.
Okay.
Exactly. Which is, so whether they make some sort of change to that, I don't think so. But the advisors have definitely been asking that. I think one thing that I personally would recommend is no one to make too much of a knee-jerk reaction. I
No.
think it's easy after such a divisive budget to then start making these calls and starting to think about client assets. A lot of these things, apart from obviously CGT coming in, most other things don't come in until April 26 or April 27. And so, it's important to take time to digest it, think about how to navigate the new sort of strategies we're in, because there is, as you said, with the inherited pension side of things, there is a huge there's an opportunity there I think for business relief and for IHT, because what you'll have now is a pond with a lot more fish in it, a lot more medium-sized and small-sized fish, because from a tax planning strategy, I was an advisor for a number of years, and if you take it, I suppose, back to a really basic version of a client, you might have a client that has, say, pension assets and and ISAs, and the idea is to accumulate those during your lifetime to then decumulate in retirement by paying the least tax possible.
Yeah.
And so, to give a really simple example, you might say be looking for £50,000 in retirement per annum, and you're going to take that as a blend of your pension and ISA assets. And really simply, you might say to your client, take 25 from your ISA, that's all tax-free, take 25 from your pension, 12.5 is at the personal allowance, so that's 0% tax, ignoring state pensions, and 12.5 grand will be taxed at 20%. So you're looking at, on £50,000 of income, maybe £2,000 to £3,000 of tax.
Yeah.
Now that's completely changed, because now also the idea is generally people will have a far bigger pension than they will in ISA. Let's say it might be, if you've got, again, just for round figures, a client with £1 million of assets, it might be £200 to £300 in the ISA and £700 to £800 in the pension, give or take. Let's call it 3 and 7. As an advisor, you'd probably always recommend try and utilize your ISA assets more earlier, because that pension will pass inheritance tax free.
Yeah.
To obviously spousal exemptions still in place, so that doesn't matter, but to your descendants or to your beneficiaries. Now, that is in my mind, that's completely flipped now.
Totally.
Because you're going to have advisors now looking at, okay, well, maybe I should be telling my clients to, if they again have that blend of 300 and 700, why don't you start taking from this asset here, this pension pot? You can take tax-free cash and do something with that, whether that goes into BR, EIS, VCT, whatever it might be. You might do regular income into a VCT from your pension, so on. So many different opportunities there. You can start draining that and only paying 20%. Again, if you're up to that 50,000, same position, you're paying 12.5 grand of personal allowance, and that remaining 37.5 is at 20%. Now, the reason to do that is that those other more liquid assets you could put into business relief qualifying schemes, IHT, free schemes, EIS as well, where you can then protect against 40% downside. Again, AIM still has a place there where, depending on, it's all client specific, obviously.
Yes.
But if you have the age of a client where they're really too young to be going into something like business relief, which is a very, let's say they're 55 and retired, unquoted business relief, it generally targets a lower target return, and so being in that for 30 years might not be the right advice. So they might still want access to the market in AIM, but still have that 20% protection from IHT. So there's just a plethora of different sort of planning opportunities now that these things have changed. And so I really, I gave that example of someone with 300 and 700,000, in a million pot. There's actually a level, maybe below that, more of, I suppose you might call it middle Britain, who were building up this huge pension pot and actually didn't really have much of an IHT problem, because they maybe don't have that many liquid assets elsewhere, as you mentioned. Pensions are such a huge part of everyone's planning. That pool just got huge because there will be so many more that come into that sort of middle band. So how I see it, I suppose, from Downing's perspective, is that we will probably see a huge influx of more medium-sized cases, smaller to medium-sized cases, for people that want to protect against that. They still value estate planning and value passing on to their beneficiaries, later in life, their descendants. And so that, as I say, the sort of planning landscape completely changes.
And you think about pensions coming to the state in addition to property, because that keeps on increasing in value and dragging people as the thresholds are frozen. So
the stealth taxes,
we haven't talked about that.
No,
because that's been extended as well, hasn't it? For the nil rate.
We could go for another hour and a half on that.
But I think the long term, it's an interesting budget, because they're looking at IHT, the most hated tax, but 4% of people currently pay it.
Yes.
But it's going to be a lot more than that in a few years' time.
Exactly.
And then, because there's that element, then the more income tax we pay, money we pass down to the next generation, and hence they get income tax again.
Yeah.
So I think it's actually a pretty smart move by the government on bringing back into a state, and I don't think it's inappropriate in some ways, because why was it out of its state?
I was just about to say exactly. I spoke to a colleague of mine the other day who said, he received an inherited pension, and he thought it was almost quite bizarre. He used it to sell off his house, to pay off his house. But he sort of thought it was quite odd, because it all goes in tax-free, it grows tax-free, and then you can take 25% tax-free. Yeah. When you think of the blended position you'll ultimately take, it's a really good position to be in. So, he sort of thought, I've inherited this pension, maybe why shouldn't I pay some tax on it? This is coming from someone that had the benefit of receiving one. As you say, most people don't even pay it. That number will obviously climb with the changes.
Yeah. There is the DB versus DC element, and obviously we've got a lot of people in the UK on defined benefits, which doesn't fall into the estates.
Yep.
But I think there obviously is a move to DC, and it will continue.
Yep.
And hence that will actually progressively add more into IHT pot coming in the future decades.
And I suppose also the appetite for annuities.
Yeah.
Because I think historically the appetite for annuities has been, since George Osborne brought in the pension freedoms in 2015, 2016, there was a huge number of DB pension pots that people wanted to move to defined contribution, right? Because if someone says you can receive, I don't know, £60,000 a year for the rest of your life, RPI linked, whatever, it does sound great. Or they say you can have, £1.8 million almost in your hand. A lot of people, there was, and the outlook, there was a huge, what they call CETVs, the cash equivalent transfer values of those DB pension pots were enhanced for a long time because the outlook for things like annuities and long-term interest rates were changing, and therefore it gave a lot of these defined benefit pension providers the ability to offer these enhanced pots. And a lot of people would have thought, okay, I'd love that freedom. First of all, it will then it was passing down to descendants. Importantly, if you said, when you're weighing up those two, you can say, yes, you get this guaranteed income and that's great, you can rest easy, maybe 50 to 60% will pass to your spouse, nothing pass to your descendants on a defined benefit pension pot. But with the DC, you say, okay, 1.8 million, it goes straight into your pension pot, you can take 250, well, if you have any sort of fixed protection, that's another conversation, but let's say you can take your 25% tax-free lump sum, and then you can use the rest flexibly, maybe you want to take more in retirement, because that was the other danger with the budget, was talking about the tax-free lump sum being changed, because some people were earmarking that for paying off a mortgage, or helping their kids, whatever it might be. So I think that's why a good example again of testing the waters, seeing that it was a terrible idea, and then changing. And so that pension side of things is such an interesting one, because there will be a huge number of pensions that moved from DB to DC over the past 10 years, probably. Well, sorry, since Osborne came in. So. Oh, almost 10 years, That sounds weird to say. And now their whole planning scenario will shift again, because it's not that the advice was wrong at the time. The advice was perfectly right. And to be honest, I would say almost all clients probably really wanted to do it because they liked the idea of that, cash in hand. But their position will now change, because they now need to think, okay, how can I restructure again, almost flipping it to the other way, to use more liquid assets, as I mentioned before, to utilise whether it be EIS, VCT, BR, whatever it might be.
So one thing you mentioned, and I think it came up in the budget, is this £1 million cap that wasn't there before. So I think we've mentioned it, but we've not really gone into the detail. And Paul, do you want to jump in as well on this in terms of where does EIS play into that as well?
Yeah, so the £1 million BR, so that's excluding the AIM element. It's the unquoted BR, so whether it's a BR product or actually EIS, which qualifies for BR, there's a cap of £1 million, and after that it's 20%, quite simply. But I think that's, I don't know, you can tell me about the average BR client, but I know it's a big chunk for an EIS investor, and I don't think very rarely people do EIS for IHT, really. It's always CGT deferral and income tax, and IHTs are nice to have.
Sure.
But, I think I don't necessarily think it will directly impact the EIS market that much, but I think it probably sits more with you. But then it's going to be quite hard to administer as well.
Yeah. Completely.
I don't know how they're going to do it. Really.
They're going to take a little chunk from every. If you've got 13 EIS, EIS 3 certificates, you've got 13 in your portfolio. Plus, you've maybe got some BR over here. I to your point, I think that there is probably a client. There's a demographic probably difference between who's suitable for EIS and BR. Generally, I imagine it's probably slightly younger people into the EIS market. They want access, they want the income tax relief, as you say. People in BR that, the average age is a lot older. They're probably looking to remove a chunk of their estate for inheritance tax purposes. So although they both fall under the same million, whether there is almost a lifestyling shift, which I sort of mentioned about AIM into unquoted, will there be a lifestyling shift from EIS into BR? All of these questions are sort of raised. But I think, in terms of the average BR case, it's I don't know, but it's probably somewhere between 100 to 150,000, I imagine, something in that ballpark. Yeah,
and EIS is much smaller. I think actually the average EIS across all of the industry is 10k.
Okay.
But that's including non-fund structures. Within our fund, it's about 60k.
Okay.
But but you've actually got to include all of those, like the crowdfunding within the
Yes.
Yeah. I don't know how they're going to manage that.
It's so tough. It's not like you have one account that you can say that's it. It's multiple.
And probate's going to be a nightmare.
Oh my gosh, yeah.
Yes.
For everyone, as you say, because I think that if I'm right, the for the inherited pensions, that's going to fall on the trustees of the pension scheme.
Okay.
So I think that also adds just another, I think probate, takes about a year at the moment. I can't imagine how long it'll take.
It's not going to speed it up, put it that way, is it?
It's not. No. It's only going to
So
slow
also,
things down.
what assets do you count first?
Yeah, exactly.
Yeah.
Is
it
there a
date of
waterfall
investment?
in terms of how it works?
Yeah. Or can we just put our hand up and be like, don't do ours first? I don't know. Or do ours first. No. Include that in the...
Pick me.
Well, it must be on a time frame, isn't it?
Well, I guess that's the devil in the detail.
When you invest it and sort of backdated. I don't know.
I think that will
That's
come out. We've got a couple of years. I think it's 30 months until it actually is relevant. But
We'll
get more detail out. So I think we've covered IHT quite significantly, and we can talk about it for a long, long time. Paul, you brought up CGT.
Yes, that was what I was
obviously
gonna...
that's the next big change, and I think probably as you say, people are using the EIS for mitigating CGT liabilities. So probably in your court this one.
Yeah, well, we saw a lot of business sales in the run up to the budget, and actually quite a few people taking out cash lump sums and pensions as well. And there's all this kite flying beforehand. There was some things which were actually in the budget, and there's some things which were not. And I kind of thought that, and there was rumours taking CGT to the marginal income tax rate, which would be horrific. But it did stimulate a lot of people to realise gains, and I think you'll see a big CGT take because of this, and there will be some deferments coming on, and obviously there were CGT increases in the budget, and they weren't insignificant, and 24%, and so we will see that roll through, and it's not going to happen immediately. I mean, there's also the entrepreneurs side as well. So there's two different elements here. There's the entrepreneurs and the business owners. Of course, they don't want to pay more CGT, but I think that I don't personally think it's going to stop people building businesses, though.
No,
I think it's going to be it is an annoyance, and that we did see an M&A beforehand, and that's and some quite rapid sale processes. And I was speaking to a lawyer yesterday who was saying she hardly slept the previous month in the run up to the budgets, and just trying to get all these business sales through. So the CGT take will be significantly up. But
sorry, just on that, is it? Am I right in saying is it 10 to 18 for basic rate?
Yeah.
And 18 to 24.
Correct. Yeah.
And the residential CGT has stayed.
That stayed. So the
18
basic
and 28.
is 18 and 28 for the higher rate.
Yep. Perfect.
Yeah. So the CGT increases. They will. I don't actually think they'll have a massive impact, but there will be more deferment. So if people are paying higher CGT, then I think there'll be more people looking to defer CGT with EIS, and having the ability to, if you made a 100k gain and you're going to pay 24k in CGT, if you put in into an EIS, you get the 30k income tax, then you can reclaim that 24k CGT, in addition to the IHT and loss relief. So that is quite attractive, and I think we will see that kind of expand over the next. In fact, the first 6 months of this year have been really quiet, and the political instability and the run up to the budget. I think the second half of this tax year will be, I would suspect, especially the end, will be pretty busy, especially into these knowledge intensive structures, which for EIS. So I think that's where what we're going to see, and but there are some people who don't even believe in deferring a capital gains tax, because then what are you deferring into?
Well, I guess I was going to make that point, because I guess if we're going to balance the argument, yes, it's great for EIS that it allows this mitigation of CGT, but you don't know what you're deferring into. So people who deferred 5-6 years ago into a lower CGT rate are now faced with a higher rate if they were to realise that gain.
Yeah, there is the redeferment strategy, which is what most people tend to do. I think. Also, it depends on the assets. If these companies have made a substantial gain, then you might choose to pay that tax. You've also got your annual allowance. So if you have exits over multiple years, well, no, but it does add up over multiple years. And you can redefer or just pay the CGT. If you're going to double, triple the money you put into an EIS, which is kind of most strategies, then that regional CGT, which recrystallizes, will be relatively a lot smaller. So I think that's the options: redeferment or payment upon crystallisation. But also the deferment and disappearing on death didn't get taken out in the budget, so you can hold it perpetually and it will disappear when
so that didn't come in, did it? Which was one of the things we thought may.
There's a few things which were absent, actually.
I was going to say, we come back to our survey we did, and it was anonymised, so I can't say that you got all the answers right, Paul. Or your forecast right, I should say, not answers, because there's no right answer. But certainly, when we look back on the survey in terms of where was the most conviction in things that we thought were going to happen, I'll go to my list here. Cap on tax-free lump sums for pensions, we've mentioned that already. That was definitely played into the market, and obviously the reaction wasn't great. Increased CGT for non-primary property, we all thought that was going to go up. Now they did increase the stamp duty for extra property, and then the CGT rates to be aligned with your kind of marginal tax rate, which I guess...
Yeah, I think that would be a nuclear bust. I think that would have destroyed entrepreneurs and I think businesses the reason you build business, partly, you should be preferentially treated in terms of tax. It takes risk and it takes effort, and you often don't end up getting a market wage. So that's why the differential between income tax and CGT is there. And if you equalise it, I think that would have really stunted a lot of businesses. But I'm glad they didn't go that far, but it is creeping up.
Yes, yeah, that's true. I guess the biggie that I think plugged the hole with its 17, 20, 40, as we said there, was the national insurance that businesses are going to pay, which I guess from a individual perspective, everyone thinks, well, that's great, it doesn't impact me directly, but it does. Yeah. What's your thoughts on that one?
I mean, you're exactly right. I think it was the easiest way probably to generate a huge amount of, I think it's expected to generate 20 or 25 billion, which
it was
I think
almost 2/3 of the fiscal gap.
I think it's the biggest
coming out of.
It's the biggest individual tax take from a budget in history. I think in the UK.
Yeah.
And as you say, it's people hear it and they go, oh, that's okay. That's the majority of it, and it's from the employer and so on. So, okay, that's fine. But when people then, when companies are hiring fewer people next year, and when you don't get the pay rise you were hoping for, the promotion you were after, well, you can probably point, indirectly, you can really point to that sort of thing, because, it is going to hit companies and employers harder, I suppose, is the summary of it. Yeah.
Yeah, it's also the reduction in the threshold. So it's not an increase in the rate.
Yes.
That's quite sneaky. I think it's £650 per person.
Yeah, because it goes from 9,100 was it to 5,000 now?
Yes, 5,000.
So
well, as you talk about a fiscal drag,
it's a double whammy.
Wow. So they increase the rate and reduce the threshold. So national insurance contributions from the employer, that was the big story, along with pensions. But in the short term, it's NI contributions from the employer, which, as you say, will. Yeah, it'll be passed on to the employee. So it'll probably be next year that you will see wages not increase as much. But then we can talk about inflation as well, maybe as well, which at 1.7% is a bit of a shock. And I think it's later on today we might see another rate cut.
Yes,
yes, expected.
Yeah. We'll see, but.
But again, with that, the national insurance, I mean, is that going to hamper, particularly for SMEs, growth? Because obviously they're incurring higher cost.
Yes, I wondered, do we think it's going to have an impact on venture capitalism?
Yeah, the government's all about growth and, pro-business, but is that?
It's not, but they need to take the tax from somewhere.
Yes.
Yeah. And I'm not sure where else it could have come from with all of their...
Because they're taking it from everywhere else already.
And I think we're at the biggest tax burden almost ever for the UK. It's like 38.5%. I think it's going to be by 28, 29, they're saying, which is a historic high.
Well, then we should have the best services ever, yeah?
Yeah. I mean, the NHS, I've not seen a pothole for a long time.
And NHS is working perfectly fine.
Exactly.
Yes, it's going so well.
So it is a high tax environment, but I'd come back actually again from this budget to think about the pensions and actually ISAs, so AIM ISAs, so that it's together they're about I think £3.5 trillion. Those the full pension pots of the UK and ISAs, and small tweaks around that large amount, it comes down into our world. And those two are mainstream tax efficient structures, and these are alternative assets. But if we can, I wouldn't be surprised if we see some flow coming down from the mainstream into the alternatives.
Yes, I mean, that's where I think from our space, it actually is all quite encouraging, isn't it? One thing I just wanted, before we wrap up, I was thinking, Paul, you mentioned with EIS the difference with knowledge intensive and then the normal EIS funds. Do you see from the budget a preference towards knowledge intensive possibly?
I think in terms of long-term industrial strategy, I think knowledge intensive EISs are the direction of travel. And I think it is for the industry, just for their simplicity, but also for kind of the UK PLC. But we haven't even talked about VCTs yet, which I think actually is a really useful structure when it comes to having income from pensions are being reduced. Then actually VCTs get the upfront income tax relief and an ongoing dividend, tax-free growth. So I think that's something which will probably be, like, I always think about it as BR, then VCT, then EIS at almost the bottom of the pile. But I think VCT will. And I'm not sure what you think about BR and that market in the future, but I think VCT will be probably the biggest benefiter of this budget.
Right, okay.
It'll be interesting because we're deep in the season, obviously, of the VCT, and there's some big raises out there, so it'll be very interesting to see where we go to. We just missed the billion last year. The 2 previous years, we were through $1 billion in the VCT market, so I kind of didn't think we'd get there this year, but this may actually give us a bit more of an impetus to the.
And we're still waiting for Octopus Titan to come out with their figure as well. We don't know where they'll go this year.
That could be an interesting one anyway, given the NAV performance. So I wouldn't, anticipate that being as big a raise as historically it has been. But obviously Northern are coming out as well. So
I think that's the difference in the VCT market. It's limited by supply. And I think there'll be the demand will increase, and hence I think that there'll be products developed and expanded so that they can fill that demand. And
definitely, I agree. I think, for example, regular income from pension maybe straight to a VCT, right? Something like that. Similarly, you mentioned obviously the AIM ISA. Our AIM portfolio is both normal and ISA, and I think again I was talking earlier on about that change in strategy, and now if you've got that ISA pot and you want to keep that wrapper. Well, you could move it directly into an AIM ISA, keep that, keep it in the market effectively, but also kept in the same wrapper, and now you've got that 20% protection from IHT. I think in
it's
a few.
It's like a Nick strategy. He always comes up with a bit of a sort of financial advice strategy. Might be better than some of his. But,
might need a disclaimer at the bottom of the podcast.
So we do with Nick.
In bold. But I think it sort of ties back to. As you say, all the changes in the budget, we've talked about so many different strategies, and I think you almost need the dust to settle a little bit for a couple of months before, certainly from an IHT perspective, before people are at the moment thinking it's 40 down to 20, right? You're losing out. But actually at some point when you realise perhaps there's not many other options to go apart from EIS or BR or VCT, then you'll start seeing it from an IHT perspective as 0 up to 20. Okay, I'm getting 20% relief. Yes, obviously in the old world, as of 10 days ago, you were getting 40%, but now you just, maybe in a month or two, people will start to see it as, okay, I'm seeing it as, the client will still have a liability.
Yes.
I mentioned before about, say, 55-year-old client, maybe they've got a £3 million estate and they're worried about IHT. Do they want to be invested in the market, but also have that protection from IHT in something like AIM, and then maybe later in life, not at the last moment with the replacement relief, but you just, move it straight across from an AIM portfolio to an unlisted portfolio. And yes, your clock might restart, but at least that you still have that protection. Or you don't move it at all and maintain the 20%. Because there's a balance between the performance of unlisted being more of a capital preservation strategy, or the AIM market, where I know the AIM market is extremely volatile. Some performers haven't done very well. As a humble plug, we have done quite well. But anyway, that's not really the point. It's more about what the client is looking for. Are they looking for market volatility and therefore performance?
Yes.
Or are they looking for being safe, I suppose? And that all comes down to that individual client, their age, all that sort of thing, whether they use EIS and VCT, whether it aggregates. There's just...
There's a lot,
it's a minefield.
I think it's encouraging as well that you're putting an emphasis on AIM. And I think there was a little bit of a concern that maybe is AIM going to struggle going forward. But from what you're thinking and the way clients are possibly reacting. They
Yeah.
see an opportunity still. Yes, okay, it's changed, but you know, people still want to go into the AIM market.
Exactly. I think, as I mentioned, if you're of a certain age and you've accumulated a huge amount of wealth over your life, well done. That issue still exists.
Yeah.
You've still got an IHT issue, but again, as I say, perhaps you believe in young. You might have a certain preference towards, okay, I like the companies in the alternative investment market, but maybe I like the idea that I'm still listed. It's still liquid, compared to, say, an unlisted strategy, which is not as liquid. And so, again, it's just completely down to client preference. But I do think that at some point, advisors, maybe in a month's time, advisors will sit in front of a certain client, they'll analyze that position, and they will come to the conclusion that AIM is still the right, still the right path to go down. And again, as I mentioned before, maybe there's that element of lifestyling later, as you do with a pension. Throughout your life, you might be in 100% equities when you're younger, and slowly you blend it down to where you're more of a mixed bag later in life. Maybe what you'll have is EIS earlier in life. Then you might go into the AMBR market, and then you might go into the unquoted market as you move through stages of life. And yes, you might have to restart that clock, but you are benefiting from some level of protection at most stages.
Yeah.
It might mean that the average age of investors comes down because you might start that planning earlier.
Yeah.
And maybe you keep VCTs running throughout that whole time as well, and reinvest. There's just
so many ways
to do it. But I do think the AIM market is still. It still has a really strong place to be. I think a lot of advisors will realise that there is huge benefit in, again, choosing the right manager that has, say, had good performance. You don't. A lot of people see the AIM all share and they see that as, okay, that's down X. There are other managers out there. I won't say who. There are other managers out there that have performed extremely well and are more suitable maybe to less volatility than growth managers, whatever. I won't get into that side of things, but yeah, as I say, once advisors realise that yes, it's not 40 anymore. We don't live in that world.
Yeah.
Client still has a 40% issue. Can I halve that to 20?
Yeah.
That's really what it comes down to, I think.
Yeah.
Quick fire question. Carried interest. That's one thing we haven't covered yet, which has gone from 28 to 32, I think, from April next year. Thoughts?
He's going to hate it. But, yeah.
They took it quite well in the end, I think. I mean, I think that generally the whole budget, I think it was such worse scenarios that by the time everything came out, everyone was like, okay.
Yeah, they did some
better than I thought.
about it. But, we will see more PE managers coming into EIS and VCT, I suspect. I don't think it's going to change an awful lot of what they do because they're making money hand over fist. So it's kind of one of the easier group to tax.
Yeah.
But it does include kind of GPLP VC structure, venture capital structures, which is a shame actually, because I think that they are something which is very innovative and could really help the UK economy grow. And there's a decent amount outside of EIS and VCT investing in venture capital. The private equity group and people, I think that they are very high earners, and that hopefully they'll come and see us at Mercia for Northern VCT and Mercia AS.
Well played.
Double plug, I like that.
Well, leaving on your plug.
One more thing I think is very important that we've missed. When we leave here now, we can all go to the pub and have a pint that's a penny cheaper.
True.
I mean, come on.
Except for it's 10 a.m.
What's the problem?
As long as we're not flying. As long as we don't.
I'm up for it.
As long as we don't fly to the pub.
No, exactly. Right, well, thank you very much to both Paul and Andrew, and Steve and I will be back again shortly.
Thank you, guys.
Thanks.
To hear more, tune in to either YouTube on video or all good podcast channels.